Very strong results over last year. Not just the 1.9 billion that was achieved a year ahead of plan, but also the commercial results. Our value new business grew with 20%. We had 2.3 billion of inflow in our DC, our defined contribution pension business, and our non-life business grew with around 4.5%. So that means that, and we've seen this over time, that we become less dependent on financial markets and spread business, as we call it, and we increase the amount of capital generation that comes out of underwriting and out of fee business, which is overall a good trend. But indeed, today we're reporting the 2024 results, and it's a good reason to follow our Capital Markets Day that will come in May, where we also come out with new targets after 2025.
Yeah, you're teasing us about the Capital Markets Day. We'll talk to you then as well, David, of course, hopefully. But the combined ratio down to 93.1 as well. You talked about fee generation. I just want to know what the catalysts there are for better fee generation, better premiums. It's a hard market rather than a soft market, I understand as well. Is that combined ratio going in a southerly direction? Is there more profitability to come from here?
Right, so we set a guidance of between 91 and 93. It's clear that the non-life business continues to do well. We saw our property and casualty business with a combined ratio of 91.9. We're very resilient around managing this book. Clearly, the motor portfolio is always something to watch. So we have been also increasing premiums where needed. The fire book has been doing well, so there we can be a bit more muted in terms of managing this book. But we continue to be very committed to the 91 to 93, and I think the good news is that we've not only been there for several years now in that range, but also the business is growing. I mentioned that the overall premium grew 4.5%. So we're combining a healthy profit margin also with a growth of the business, and it led to a very strong operating capital generation for the non-life business. So that's overall a positive that we also expect to be able to continue.
David, this is Carolyn jumping in. Good morning to you, and congratulations on the numbers. You've long made the point that one of the key drivers for your business is the lack of penetration in terms of insurance products across Europe, specifically also Eastern Europe. With the rise in geopolitical tensions, do you expect that demand to only increase going forward?
Yes, indeed. Good morning, Caroline. Yeah, the European business has been consistently growing. I mean, if you go back to around 2020, it was around 250 million. We're now at 461, so the business almost doubled since that period, and that has really been on the back of this under protection that we see in these European markets. And yeah, with all the increasing uncertainty, that's typically a reason that customers start to even think more about how well they are protected. And governments have been struggling to provide that protection. Employers are not always willing to do this. So that means that individuals have to step up. And so I think it's partly under protection. I think the other part is distribution. You need to be able to talk to the customer, because most people don't wake up and start buying protection products. And we've been heavily investing in our tied agent channel. 38% of our sales actually comes through the tied agent channel. There's a lot of AI tooling now. We used to say, these tied agents channels was like an art, but it's really a science now. It's very data-driven on how we manage the agent to the right customer at the right moment. And that has led to actually the tied agent channel being our largest channel in Europe. So I think it's a combination of under protection, but also having a very strong distribution platform that enables us to continue to show growth. And also for the coming years, I expect that the European business can continue to grow as it has been doing.